Something important shifted in markets this week. Not dramatically, not in a single headline moment, but quietly across several asset classes all at once. Gold closed the week at $5,175. Oils pushed towards $92 a barrel. And the latest US jobs data showed clear signs that the labour market is beginning to soften. Put those together and the market may be starting to price a different environment than the ones investors expected just a few months ago. Welcome to Money and Power. Now, before we dive into the data, I want to say a massive thank you to those who sent in tips this week. As an ambassador of this mission, every penny goes towards upgrading our research tools so I can get these reports to you faster. A reminder that for those who've subscribed to Substack, we will also be issuing this video there. And for paid members, an even more detailed analysis will be published tomorrow in plenty of time before markets begin. To subscribe to the paid version, which begins tomorrow, please follow the link in the description and comments section below. Then you will not miss out on any of the additional reports paying Inner Circle members will receive. So in this video, we're going to step back and look at the full market picture from the past week. Equities, precious metals, oil, currencies and crypto. And then discuss what investors should be watching as we move into the week ahead. Now, because when several markets begin moving in different directions at the same time, it usually means the underlying economic story is changing. So let's begin with equities. On Friday, the Dow Jones Industrial Average fell 453 points, closing at 47,501. The S&P 500 declined 91 points, ending the session at 6,740, and the Nasdaq dropped 361 points, finishing the week at 22,387. Now, these are not catastrophic declines, but they do show that investors are becoming more cautious. Looking at the broader trend over the past month gives us a slightly clearer picture. The Dow Jones is down about 2.9%, just shy of 3%. The S&P 500 roughly 2%, and the Nasdaq around 1.2%. Now, across the Atlantic, the weakness has been more noticeable. The FTSE 100 closed Friday at 10,284. That's down 129 points on the day. And over the past month, the UK market has fallen just over 5.5%. When multiple developed markets begin drifting lower together, it often suggests investors are reassessing risk. It does not necessarily mean a crash is imminent, but it does indicate that the market is becoming more selective and more sensitive to economic data, as well as geopolitical data, which we will come on to. And this week, that economic data came from the United States. One of the most closely watched reports of the week was the latest US employment data. The report suggested that the labour market may finally be losing some momentum. Hiring slowed and unemployment edged higher, reinforcing the idea that the extraordinary strength of the post-pandemic labour market could now be fading. Why does this matter? Because for the past 2 years, the US economy has been supported by strong employment, rising wages, and resilient consumer spending. If job growth begins to weaken, the entire growth narrative begins to shift. For central banks, this creates a difficult balancing act. On one side, weaker employment suggests the economy may require lower interest rates, and on the other, inflation risks have not disappeared, particularly when energy prices are rising again. And that brings us to the second major story of the week, the geopolitical risk premium, oil. Brent crude finished the week at $92.69 a barrel. This is not yet a crisis level for oil prices, but it is high enough to influence inflation expectations. Energy prices are particularly sensitive to geopolitical developments, and the situation involving Iran and the wider Gulf region remains a key risk for markets. Reports during the week suggested that Chinese naval vessels, including advanced Type 055 destroyers, may be moving towards Iranian waters as part of wider military exercises involving China, Russia, and Iran. Whether these deployments represent routine naval cooperation or something more strategic currently remains unclear. But for energy markets, the issue is straightforward. The Strait of Hormuz remains one of the most important oil transit routes in the world. Roughly 1/5 of the global oil supply passes through that narrow corridor. Any escalation in regional tensions immediately raises concerns about supply disruptions. And when energy markets begin pricing in geopolitical risk, those effects can ripple across the global economy. Higher oil prices increase transportation costs, raise industrial input prices, and ultimately feed into consumer inflation, which is why central banks watch oil markets very closely. Now, before I turn to precious metals, if you find this sort of information useful, it would be very helpful to this channel if you give this video a thumbs up and also subscribe if you haven't already done so. This then ensures that YouTube advises you, or hopefully advises you, when a new video is released. Precious metals, a signal beneath the noise. Gold finished the week at $5,175 per ounce. Silver closed at $84.71. Both metals remain historically elevated, even though they've not been moving in a straight line higher. Gold's strength reflects a number of underlying forces. First, central banks around the world have continued accumulating gold reserves as part of long-term diversification strategies. Second, geopolitical tensions tend to increase demand for safe haven assets. And third, persistent uncertainty around inflation and interest rates encourages investors to maintain some exposure to tangible assets. Silver often behaves slightly differently. While gold is primarily viewed as a monetary asset, silver also has strong industrial demand, particularly in sectors such as solar, electronics, and advanced manufacturing. This dual role means silver can sometimes move more sharply than gold in either direction. At current levels, both metals appear to be reflecting a world in which uncertainty remains elevated. But they're also responding to something deeper, the possibility that the global financial system may be entering a more volatile phase. Now, the US dollar is a quiet but important signal, and the index currently sits around 98.98, in other words, just shy of 99. That is an important number. A weaker dollar tends to support commodity prices, including gold and silver, but the dollar hasn't collapsed. It's drifted lower from its highs, but it's actually started to rise recently. This suggests that investors are not abandoning the US currency as a safe haven. Instead, the market appears to be navigating a middle ground, cautious about global growth, but not yet convinced that a major financial shock is imminent. Currency markets often provide the earliest signals of changing global conditions. For now, the dollar is sending a message of uncertainty rather than panic. Now, a quick note on crypto markets. Bitcoin is currently trading around $68,000, which means it's still up roughly 6% over the week, although it has pulled back slightly over the last 24 hours. The broader takeaway is that liquidity-sensitive assets like crypto are still responding to the same forces affecting everything else: interest rates, the dollar, and overall risk sentiment. When financial conditions tighten, crypto tends to move quickly, both up and down. So while digital assets remain volatile, they're increasingly reacting to the same macro signals that are influencing equities, commodities, and currencies. So, looking ahead to next week, there are three areas markets will be watching closely. First, US economic data, particularly inflation and growth indicators, which will help investors understand whether the softer job numbers we saw this week represent the start of a broader slowdown. Second, energy markets, because oil prices are now moving higher again, and any escalation in the Middle East could quickly feed into inflation expectations. And third, interest rate expectations, particularly in the United States, because markets are still trying to determine whether central banks will be able to ease policy later this year. Those are the broad signals. But in the 2% brief, particularly for inner circle members, we will go deeper, much deeper, looking at the specific data releases, the timing of those events, and the indicators we watch for potential buying or warning signals across gold, silver, and wider markets. If you want that deeper strategic framework, you will find the full weekly briefing there, and links below. If you found today's update useful, please consider liking the video, subscribe to the channel, turn on notifications so you don't miss future analysis. And if you like the deeper strategy behind these market moves, please join the 2% brief on Substack, where we explore the signals beneath the headlines. Thank you for watching, and please take a moment to watch the videos now appearing on your screen, if of course you haven't already done so.